Hello, everyone. Welcome to the NASDAQ Dorsey Wright webinar for the week ending on July 12th.
Something like that. We're recording a little bit earlier than normal.
We are. So, yeah, week ending on July 12th. We're recording earlier in the week on July 9th, though, on Tuesday. And I believe that this podcast is going to be coming out a little bit earlier than our typical Friday. So, we just wanted to bring you all this wonderful podcast a little bit early.
Yeah, we also didn't see you last week because it was 4th of July. Speaking of, how was your 4th of July, Ian?
It was good.
Did you melt out there?
I tried not to. I went down to the river here in Richmond. It's funny. We have like the River City, so it's obviously a lot of like water right here in the city. But I think everybody leaves the city during the 4th of July.
Right.
We were driving around, it's like no one's on the roads. And could walk into a restaurant and get a table right off the bat. It was pretty awesome.
So I went to a Squirrels game, and I think
Flying Squirrels is
the
a
Flying Squirrels,
minor league baseball team here.
they're amazing. It's great.
Not this year.
They're really bad. Anyways, we went there on Friday, and I was expecting, day after 4th of July, I was expecting that, crowd was going to be full. It was not. Everyone left. I was like not even sold out, and typically for reference, the Squirrels are a very popular minor league game.
Right.
Games are sold out all the time.
It's the only semi-professional sports that we have in Redmond. So
Right. Yeah.
they get a good following. But yeah, the 4th is good. Sounds like yours is good too. And markets had a pretty good start to the month of July as well.
Yeah, they did not act like it was a shortened trading week. Nasdaq 100, Nasdaq Composite, all the big guys, they were up, over a couple percentage points over the course of those 3 days.
Yeah, it's like every day we come in, not much going on except the all-time highs, right?
It is nice. One day we'll look back on it and say, we wish we could go back to that time period.
Yeah, I think I can remember some recent years in hindsight where wishing we were there. But given that we are starting off July,
right?
We ended the second quarter, into the first half of 2024, right? Which is weird to think about. I mean, I feel like we were doing 2023 wrap-ups in this room like not too long ago. It was 6 months ago. It's crazy to think about. But part of the quarterly review pieces that we put out a variety of different kind of quarterly wrap-ups. And typically, at the start of each quarter, there's looking like top and bottom performing ETFs for the quarter. How did different factors do over the past 3 months? But one of the more recent additions that we've had to our quarterly content is a quarterly report, right? Which is, seems like it should be something that's kind of the mainstay of any research shop. But we have a lot of pieces that come out on like a daily, weekly basis.
Right.
And so we try to stay really up to date. We do stay up to date with what movement's going on in the market. But it's always helpful to have perspective when you kind of have a lot of content throughout 3 months. You can kind of aggregate it down into what were the important themes that we looked at or we saw over the prior 3 months, and kind of what are we looking at over the next quarter, right?
Right.
And I think that's kind of the origin of our quarterly report. And it's affectionately called the weight of the evidence. So that's
the name.
It is. You came up with it, I think. So, this was a piece of Miles definitely kind of is taking a lot of the lead in putting through here. So we want to spend a lot of time today kind of going through, or not a lot of time, some time going through a few of the major takeaways that we had from that piece. Is that fair?
Yeah, that's fair. And just for you all listening at home, we're going to throw the link to this report down in the description of the video. So if you want to, feel free. It's 23 pages. Don't be intimidated by the length of this thing. We've designed it to be incredibly modular, incredibly light, and kind of jargon lists, right? So if you're not familiar with Dorsey Wright or our methodology, you can still follow along, and hopefully it'll make sense. But again, link down in the description to go ahead and download that, follow along. But today's podcast, we're going to be running through specific spots.
Yeah, and the jargonless comment that you made, we're still going to have some of our like major indicators and stuff in there, but it is important to note that this review is approved for technically non-financial professionals, right?
Right.
It's meant to be written from a perspective of anyone that has a relative kind of idea about what's going on or wants to know more about what's going on in the market, can pick it up and get a feel for what we're looking at, right? You don't have to know exactly how the bullish percent is necessarily calculated in order to understand all 20 pages of this report, right? But there were a few things, and to that point, that were kind of have been discussed from a broader perspective, whether by us or by other people across the financial kind of media space, that we saw some interesting points throughout throughout the last 3 months. One of those being an area that really just kind of continued to stay the same over the past 3 months, and that's been our bread and butter and momentum, right?
Yeah. Oh yeah. I mean, it's opened up. I remember when we were putting together Q1, we were saying it was a historic first quarter for momentum, which it was. And momentum continued to outperform the broad market in the second quarter, and then kind of putting those two together throughout the first half of the year so far. So it's really just been more of the same, to your point about that extended leadership. And also, on the contrary, the extended, laggardship is not a word, but it is now. The extended leaders and laggards we've seen throughout the market really lifting momentum higher. And another kind of actual statistic about this is we took a look at momentum proxy MTUM, which is the broad ETF for the factor.
More academic momentum, which is a little bit different than the way we look at it. But when people say momentum across the space outside of Dorsey, right, that's typically what they look for. Your 12 minus 1 leaders kind of portfolio.
Right. Thanks for that clarity. But point being is that when momentum has outperformed the market in the first half of the year, about 60% of the time, a little over 60% of the time, we see continued outperformance for the rest of the year. So that's a long sentence to just say the path is still kind of clear for momentum to have a productive rest of the year so far.
And I think it is interesting that you had a point in the last paragraph of this, or we had a point there. The third quarter tends to be the worst quarter for momentum and the market.
In the market, yes.
Right. So you see momentum kind of follow suit with the broader market that we might, the kind of potential pickup in volatility, we're at all-time lows from a volatility or multi-year lows from a volatility perspective. Market turbulence typically isn't great for momentum. And so if we do see volatility pick up, that does enter the potential for maybe some resetting in the third quarter. Is that fair?
Well, here's what I think. Everybody's vacations are coming to an end. They're coming back to work. People are a little bit cranky, right? And so markets get a little bit of that a symptom of that. But in all seriousness, right? The markets in general, seasonally weak period of the year, July, kind of asterisk there. July is typically at least pretty strong,
right?
But kind of that August, September type of month, things are a little bit quieter from a return perspective. Quieter meaning bad.
Yeah, more muted. September is seeing some really bad times. Seeing some good times too. The kind of love-hate relationship that we see there play out. But yeah, that August to September definitely going to be maybe if they're not cranky coming back from vacation, they're going to be cranky going back into work full time there, maybe in September. So
right. Well, and then you kind of we can just list off all the months. September, November is also an important one. Look at that transition. Why is November important? What's the next thing we're going to talk about? Presidential elections.
Yeah, there you go. November is definitely more important this year than it probably is in most years. And so one of the other points or takeaways that we have is looking at seasonality. So when we're looking at the presidential election year, you see a lot of return charts put up there about here's how the market does in presidential election years when a Democrat is elected or when a Republican is elected or it moves from a Democrat to a Republican or continues, whatever it might be. At the end of the day, what we've kind of found from most of our return analysis is that it doesn't really matter all that much, the actual party in power when you're looking at it. You see some major years that are major declining years with the Democrat in power, major declining years with the Republican in power. It really just kind of filters back down to, did we have a bear market during that year? Yeah. If we did, that's going to affect your overall average returns, right? But when we're looking at, you can definitely see the definitive themes play out when you separate off the presidential election years or presidential term years by year. So when you're looking at year 1, 2, 3, and 4 of each presidential term, there are definitive themes that play out in terms of when the market's up or when the market's down in each of those years. The second year, typically the worst. We saw that happen in 2022, bear market. The third year, typically the best. So far, it's been the best of the 4 in the case. Never say never. We can maybe have 30% up 6 months of the year to go, and then we'll break that norm. But typically, second year the worst, third year the best, and the fourth year is typically about average. In an election year, going back over the past 100 years, all the way back to 1928, we see the S&P average about 7.5% in an election year. About average. To put it for perspective, the market average in any year is 7.85%. So right up the same on average. And if you break that down a little more by quarter, so in the quarter of the fourth year, so getting a lot of fourth year.
Here we go.
But when you have the last 2 quarters of the presidential election year, so the second half where we're looking toward now is positive 83% of the time for The second half of an election year is positive 83% of the time. And we were talking about before hopping on here. I think at the end of the day, a lot of that circles back to uncertainty, right? No matter who's in power, what party is in power now, what party might be in power in the future, markets don't like an uncertain environment. And so when you have typically the presidential candidates, or at least wrapped up in the first half of the year, most times, we'll see what happens this time. But typically the candidates are wrapped up in the first half of the year, and that allows the markets to at least process some potential routes. There's no longer 10 people they can go to.
Exactly.
Right. There's two kind of opportunities or things that keep price into the market movement, right? And so when you remove some of that uncertainty from the market environments, like that, they do pretty well. And we know that after the elections, we have other pieces that we won't dive into, but November and December, specifically in election years, tend to be very positive. So like after you figure out who's actually going to be president, markets tend to like that a lot more because then they can price everything in.
Right. Well, listen, you said pretty much everything. Just that you said pretty much everything really well there. I mean, it's going to be regardless. I can think of a couple of scenarios where we could see, to put it in a market perspective, the VIX spike a little bit.
Right.
So that's kind of
uncertainty could always come back in.
It could. So we'll have to see, but I think a good wrap up point for the presidential election part is that second half is typically positive, right? 83% of the time historically. Now, I'm not a betting man, but I mean, that is a strong percentage, at least historically. So
yeah, absolutely. And we had another bit in this piece that looks at kind of breaking off different halves and then years by, if you got double digits return in the first half of the year, right? What do you typically see in the second half, right? And then if you got double digit returns the prior year, right, and also in the first half of the year, what do you typically see?
Which is that scenario right now for those of you who are keeping track. A 10 plus return last year and a 10 plus return to open this year. That is a lot, but typically speaking,
so it's a lot of positive.
Yeah, that is. And the question based on that is, well, can it keep going, right? I think that we're touching a lot of stuff. Momentum, we asked that same question with just broad market stuff. We're asking that same question. Can it keep going? And at least history has said, yes, it can. And it's maybe a little bit harder to do when we're talking about back-to-back 10 plus years of return. So it's a little bit harder to follow up, but again, not impossible. Am I saying that right?
No, I think that's exact. So, I mean, we mentioned that the fourth year president return tends to be a little bit more muted, but still positive. And to your point, you see that exactly play out when there's been 28 times the S&P has gained 10% or more in the first half of the year since 1928, which is the study that we're looking at. Only 7 times have we seen the S&P lose ground in the back half of that following year. This is just looking at up 10%. What do you do in the second half? Only 7 times. Now, out of those 7 times, 5 times did see a decline after the S&P was already up 10% in the year prior. So you do see a little bit more of a heightened potential for some more muted performance or some potential losses in the second half. The long story short, it's really, from an averages perspective, maybe just a little bit more muted, but still positive is kind of what we're looking at there for the second half of the year, at least from a historical seasonality standpoint.
Right. And the name of the game, of course, everyone's always going to have something that's this time is different. This time is different. The name of the game, we're not going to harp on it too much because we've already done so, in our research and in previous podcasts. But the name of the game is really going to be market participation. If we can see participation, upside action broaden out into small caps, which really just continue to, for lack of a better word, suck for the average stock through the S&P 500 equal-weighted index. If we can get those guys to participate higher alongside the Magnificent Seven, there's much more, at least in my opinion, much more of a chance that we see, hey, this is one of those scenarios where it's not as muted, right? We can continue to see things move up higher. Now, if we continue to tread water in those areas, maybe we get to see a little bit more muted performance as those generals of the market get a little bit more tired.
Yeah, and to the point that we had on earlier, so we hit on momentum continuing its themes, right? We've hit on some seasonality aspects, which are kind of generally positive looking towards the second half of the year. I mean, momentum is inherent. It's looking at leaders, right? We've seen the leaders continue to lead, and momentum strategies have been able to capitalize on that by maintaining exposure to those leadership areas in the market. So as long as those are continuing to kind of be the leadership areas in the market, then that's kind of bodes well for momentum as a whole as we're kind of moving forward, right? But the good thing about momentum or what we do trend following, it's objective and it's self-correcting.
Right.
If it's
It
wrong,
can go anywhere.
if it's wrong, it's not going to stay wrong, right?
Right.
It will correct, it will move into areas of strength, we'll pivot away from areas of weakness. But we just have to wait for potential changes if that is going to come in the second half of the year.
Yeah. Speaking of potential changes, though, I don't know if we mentioned it in a podcast since we last talked to you all, but we did see some shakeups in our broad rankings due to more so of that weakness emerging within international equities and specific spots within an international equities that saw some of that relative strength or negative relative strength enter the conversation, mostly in Latin America.
Yeah.
So you want to set the stage in terms of what we saw happen and, maybe what's going on. I know you're the international guy.
Yeah, well, I don't know about the international guy, but I think that going through some of the analysis here, I mean, I think you mentioned it with small caps not doing well. Was I think how you phrase it, right? Was
Something like that.
Yeah, and small caps not doing well. Well, they're not the only area that has not done well over the past few months, specifically within international equities. As Miles mentioned, we have our broad dolly asset class rankings, ranks broad asset classes 1 to 6, right? Domestic equities firmly entrenched in that top position with some of the themes we talked about there for the beginning of the podcast.
Good to see.
Good to see. International equities had been in second, and as you said, it fell to third. That allowed commodities to take the second position. We didn't see commodities really, I wouldn't say improve into the second position or earn it, certainly not. Really, they just kind of stayed the same, and international fell below.
Yeah.
And so we saw commodities take over that second position. International now sits third. They're only separated by one last signal, so they're very, very close. A couple days of market movement could change that relationship. It hasn't yet. It's been that way for a few weeks at this point. But on the international equity space, as Miles hit on, really a lot of the culprit for that declining strength was Latin America. Within emerging markets specifically, we've seen a lot of news headlines around emerging markets over the past several weeks, maybe a little bit more in France on the developed side over the past week. But in looking at emerging markets, we saw the last 3 months allowed the broader emerging markets representative, EM, to overtake developed markets, EFA, on a year-to-date basis. So emerging markets are now outpacing developed markets, ex-US, on a year-to-date basis. That was not due within the broader international space. That had been a theme of improvement that we've seen from some focused areas. China had been a laggard, India had been strong, Latin America had been strong, and they gained signals in our dolly rankings. We saw Latin America tail off significantly in the second quarter, and so it lost all those signals in our dolly rankings. And so that's really the culprit behind international falling was Latin American weakness. You saw areas like Brazil, like Mexico, move a lot lower. They lost strength, they lost momentum, they moved into negative trends, and that allowed the international equities class to fall lower. But there's a lot of other areas outside of Latin America within the emerging market space, right?
Namely China.
China being one in particular that's seen improvement, but not enough improvement to kind of counteract the weakness from Latin America, right? We saw China really have a big pickup into the first 2 months of the second quarter. It had a good February, good March, good April, medium May, and then in June it started to trail off. We saw it improve so much, you got to get back a little bit, right? So that's kind of what we've seen at least up until this point there in China. So it needs to pick up a little bit more strength, that we're going to see more signals gain in its favor is really important there in the China space.
And here's what I'll say. I think China, at least this specific rally, right? China was at all-time, well, near decade level lows. I won't say all-time lows, near decade level.
It was all-time score lows.
All-time score lows.
Yeah.
Point being, it started to rally, right? And I was, kind of eyeing, I was like, is momentum going to pick up China? Because we were saying, hey, we need to see more improvement. We need to see more improvement, right? And we ultimately didn't see that improvement, right? And so that kind of speaks to momentum's ability to not always fall for these sharp rallies all the time. Because if it would have fallen for China. It corrected pretty strongly.
It did, yeah.
I don't know if I'm saying that correctly, but the point is it didn't chase. And so that kind of shows momentum's ability to find these areas and wait patiently until you see strength prove itself, right? Or in Latin America's side, hey, we're seeing relative strength here, relative strength here, and then it falls off, right? So then you kind of trim and rotate out of those positions. So I don't know. I don't know if I'm vocalizing that correctly, but just seeing momentum interact internationally, I think was a unique spot here.
And momentum is historically done pretty well internationally, right? Because where does momentum do best? It does best in areas of high dispersion. there's a lot of dispersion in international equities. Some areas do very well, some areas do very poorly. To your point, China had done very poorly for a while, right?
Right.
And so a few months of outperformance are not going to be enough to undo that outperformance, right? Latin America, like you said, on the other hand, I mean, you look at like the kind of score graph, you see it just kind of moving sideways and then drop. That drop is enough for it to like lose strength in the rankings. But yeah, you need China to pick up the pace a little bit more. I mean, you talk about other areas coming in the fold, domestic equities. If we want to see international equities, I mean, really have a chance to kind of rise back up, gain some strength in the second half of the year. You need to see China kind of pick back up the pace. You'll see some signals start to kind of flip back, maybe more towards the international equities favor. If that does happen, would be definitely a big point to kind of look toward as we move through the next 6 months. But your initial point, India has been another area that's just, you talk about steady Eddie up the top. It has
hanging out there
near the top of our like asset class group scores rankings for a while now, and just continues. It's one of the only groups with an average score north of 5, right? Which our scoring system 0 to 6, 5 is pretty strong.
Right? It's been up there for quite a while.
It has. It continues to do well. So it's not all areas within emerging markets have shown weakness. China's kind of backed off a bit. Latin America's shown weakness. India's been very strong. Taiwan has been another area. You talk about areas with international equities within Asia, emerging Asia specifically, that we were wondering if it was going to move into momentum was going to move into those areas. Well, it did move into Taiwan. We see a lot of momentum. Our momentum strategy picking up exposure to Taiwan. Obviously, semiconductors being a big part of that. It is momentum is definitely doing well, kind of discerning between areas of strength and weakness. But if you want to see some big tailwind effects for the broader emerging space, you need some of those bigger players like China to come in full more.
Cool. Well, let's see. I think that we'll probably do it as do it us here.
We got like 16 more pages we can go through. And this
if we still have you here again, go check that out. It's in the description. Other things of note this week, we won't touch on them, but again, maybe something for next week. So we have inflation data coming through on Thursday. That's probably going to be a hot topic, I imagine, as we digest maybe rate expectations for the rest of the year. And also big banks opening up earnings on Friday. So a couple of things to watch out for the rest of the
big banks, little banks. That's and so with these two, I do want to throw a special shout out to our big event we have coming up this fall. So our Catapult event is going to be taking place in Nashville in October 15th to 17th, I believe. So if you like the sound of some of this stuff, then we're going to be talking a lot more about technical movement going on in the markets at this event. Again, it's going to be in Nashville. We've opened up registration, seeing good numbers in. And so definitely be sure to grab your spot if you're coming. If you don't like listening to Miles and I talk, there will be many more people that are going to be on stage though. So you don't have to come just to hear us talk about what's going on.
Grab your spot, grab your cowboy hat. We'll see you there.
Yeah, there we go.
All right. Have a good one.